my name's Abbey Phillipps and welcome to JMM Insights. Today I'm speaking with Barton Gold, ASX code BGD, an Australian gold developer targeting future gold production of 150,000 ounces annually with approximately 2.25 million ounces JORC Mineral Resources and 100% ownership of the only regional gold mill in the renowned Central Gawler Craton of South Australia. Joining me today is Alexander Scanlon, Managing Director and CEO. Alexander, thanks for joining me.
Thank you for having me.
Firstly, for people who are new to the story, can you give us a quick overview of Barton Gold and what you're focused on?
Yeah, I think a really short summary is that we are a pure play precious metals business, mostly gold. We saw an opportunity to establish and have established a dominant position in the center of the Gawler Craton in central South Australia. So this is a regional 130-year-old gold district where we have consolidated ownership of the substantial majority of all major historical exploration and production assets. And we've spent essentially our first 5-year act as a public company building these up into a platform, which is essentially a dual hub and spoke strategy to produce 150,000 ounces of gold. That is first leveraging our existing mill to go into operations, and then leveraging that to build our second mill and a much larger project. So essentially our next 5-year act starting in 2026 is all about commercializing that platform that we've built up.
And you often position Barton as a developer rather than just an explorer. How does that mindset influence decision-making and capital discipline?
Yeah, I think one way to better understand Barton Gold is to not necessarily think of us as a junior explorer developer. If you look at our team and our track record, both as, I guess, advisors or developers and principal investors, we're probably better understood more like a private equity investor or professional asset manager. What that means is that we tend to take decisions in terms of capital allocation on much longer term timelines and on considering more factors than just sort of immediate short term decision making. That includes, in particular, allocating capital with a focus on very attractive outcomes, but then focusing on risk mitigation as we approach and advance those outcomes. We're also focused on generating real optionality around our assets. So thinking about how we allocate that capital to make sure that we're sort of pre-opening doorways today that enhance future value and regional value, not just in that asset, but our other surrounding regional enhancement assets, for example.
Now, Barton has outlined ambitions to become a meaningful gold producer. What does the journey from today look like to production scale over the next few years?
So again, the year 2026 for us is really focused on commercializing this dual platform that we built. Stage one of that platform is leveraging our existing Central Gawler Mill. That's a fully permitted mill. We are doing upgrade drilling presently. We've announced that just a few days ago. That will then feed a definitive feasibility study, which is focused on a really de-risked model for transitioning that mill back into operations. We are aiming to complete that DFS by the middle of the year and then move directly into front-end engineering design and then commence works by the end of the year. In parallel with our stage 2 asset of the Tunkillia Gold Project, we are doing about 50,000 meters of upgrade drilling. We've done about 20 of that at just before Christmas. We will again be upgrading those resources, completing a pre-feasibility study, which would be a very advanced pre-feasibility study, and then applying for a mining lease application also by the end of 2026. So essentially, we're putting both of these on a commercialization track where stage 1 is leveraging the existing mill and the development of our stage 2 mill is leveraging the operations at stage 1.
And on that topic, Alexander, Barton controls the Central Gawler Mill, being the only gold mill in the Gawler Craton. How important is owning that infrastructure to Barton's overall strategy?
It was a cornerstone element of our regional strategy. So when we bought the historical Challenger mine, Tunkillia mine, and the Tonkilia Project, we saw a significant amount of capacity or potential there to grow these materially, which we've done. So we've grown this portfolio from about 600,000 ounces to about 2.2 million ounces. But the ability to acquire that mill, being not only the region's only mill, but an established mill, was quite important. So we essentially made the decision to acquire that and park it while we stepped back and did a lot of regional geological work. The mill gives us leverage not only to our own mineralization and not only the ability to transition to producer relatively cheaply, but it also then gives us leverage to extend that infrastructure position. So if you can cross that bridge from pre-operations to operations and re-rate your company's sort of credit and equity profile and then go for growth, it's a much easier pathway in a manner of speaking and ultimately far less dilutive for your shareholders than trying to go maybe to your end destination of scale, but not having that very valuable stepping stone. Then if you have the only two mills in the region, well, that then gives you a further fairly material advantage regionally when you consider the consolidation of future economics in the area.
And moving into some of the projects now. So Challenger is often described as a lower risk opportunity within the portfolio. What progress at the Central Gawler Mill will help bring Barton closer to potential production?
So we've recently upgraded resources there to about 300,000 ounces of resource, and that's between some historical tailings and higher grade open pit and underground material. We have just started resource upgrade drilling there to bring the mineralization that we're targeting in the tails and the open pittable mineralization up to JORC reserve status. And then that will feed into a DFS that's currently underway. And again, what we're targeting here is a low risk transition to production. We're essentially just touching the historical tailings and lower grade open pit mineralization on a low risk model. Bringing that mill into operation then really enhances the development optionality of all of our surrounding assets, including the high grade mine right underneath it, including our Tunkillia Gold Project where we have a mine, including our Wadena asset we just acquired, which looks like it can produce and truck a high grade concentrate, and then potentially even our high grade Tolmer silver discovery just to the south, which certainly could probably use that same mineralization. So we have in particular some fine grinding test work going on right now, which will be really central to equipment selection and flow sheet design, and then also working out energy solutions so that we can put together a really attractive, we think really attractive low cost de-risk approach going in the middle of this year.
And resource upgrades at all assets remain a key focus for the company. Why are higher confidence resource classifications so important at this stage of Barton's development?
Yeah, so I guess if you think about capital allocation, we're not drilling just to find mineralization. Like the discovery component is really important. But after you've discovered mineralization, if you're making the decision to continue investing in a project, what you're essentially doing is investing quite heavily in future production. So resource upgrades is an investment in the confidence interval you have around that future production, which is why we have these different confidence intervals in JORC resources and therefore JORC reserves once you start putting economic studies around there. So what we're really doing is supplementing already some very strong data sets in terms of geology and geotechnical data and structural data. This allows us to do better modeling, both in terms of the resource, but also even the production modeling. So if we can model the domains of the mineralization better, we can more accurately predict how much we're going to require in terms of consumable A, B, and C, and how much energy is going to be required between various different domains. So it takes you into a much higher confidence area in thinking about what the economics of the project themselves will be. But it also provides, quite importantly, a lot of comfort to the many credit partners who have expressed an interest to work with us in the development of some or all of our projects.
And recent work at Tunkilia points to strong early economics from both scale and higher grade zones. How does that balance help shape a project that can deliver early value, and what makes this asset stand out in the current gold market?
Yeah, look, so with any large capital allocation, you are looking very closely at returns metrics, and essentially that dials down to how quickly can you pay back that capital allocation. The faster you can pay that back, the lower risk that allocation is. And that's really important when you think about credit financing. So, professional lenders, they want their money lent for duration on longer term because they have large pools of capital they want to earn a return. but they really want to know that if push comes to shove and if things go sideways, they can get paid back in 2 years instead of 5 or 3 years instead of 6. In the case of Tonkilia, this is a large-scale project focused on efficiencies of capital and operating costs. It has a central higher grade zone. The effect of this is that when you have a very efficient large-scale mill and a marginal boost to grade in the middle, what you get is a very fast payback period. So we modeled that project in May of 2025 as producing over $800 million in operating free cash in the first year alone. That would pay back the entire development cost 2 times over in the first year, assuming just full equity finance. That was based on gold and silver prices of 5,000 Australian and $50 Australian. So now this project, again, it shows you the leverage it has to either marginal grade or marginal dollars, which is essentially a proxy for marginal grade. This project would now produce about $1.25 billion in operating cash in the first year. So it gives you a lot of credit comfort. The flip side of that, to the credit analysis, is the credit comfort derives essentially of fast payback, which derives of really high margins. When you look at the economics that we modeled for this project, it looks like we should be able to produce 1 ounce of gold for less than 1,000 Australian dollars during the first year. So this will actually be one of the lowest cost gold producers in the world during its first 2 years of operation.
And looking ahead to further drilling programs, what are the main questions you're looking to answer to keep de-risking Tunkilia?
I think the key one, obviously, is a more detailed resource and reserve model that then feeds into more detailed production modeling. So the more understanding we can get around that, the better confidence we can have in the actual month to month, week to week, day to day economics and consumption and production of this project. That gives us greater visibility and comfort. It gives lenders greater visibility and comfort. It also gives us the ability to actually do much more refined trade-off optimization. So starting to look at precisely how large should the mill be, precisely which equipment should you be using in equipment selection and trade-off analyses. And the more data you have, you can keep finding these areas to save 1%, 2%. It actually adds up quite a bit in the final project design and profitability.
And turning to your other regional enhancement assets for a minute, can you briefly update investors on your exciting Tolmer silver discovery and any plans for 2026?
Yeah, so we have 2 sort of chief regional enhancement assets as we refer to them. So 2 hubs, 1 mill at Challenger, 1 mill at Tunkilia. We've acquired a regional enhancement asset at Woodinna, which we think will produce a high-grade concentrate. But between the 2 mills, Challenger and Tunkilia, we have our Tunkillia Project, and that's where we've made this Tolmer silver discovery. So this was, for those who haven't followed, quite surprising in a sense. We predicted a new structural model. Sitting within a 130-year-old gold field, so we were expecting to find gold. We found gold, but we found much, much higher grade silver. And the western portion of this Tolmer discovery is actually the world's highest grade silver intersection and discovery for 2025 on all markets. So that's very exciting. We've drilled that now 4 or 5 different times, trying to follow up and figure out what's going on with the structure, what's hopefully created this particularly high grade silver. We've just completed some more diamond drilling that will give us or has given us some greater structural insights. And we are now planning follow-up drilling for early 2026 and potentially follow up on that again during middle of 2026. What we're trying to do is turn this increasing structural confidence and knowledge into more data points to hopefully achieve continuity in the resource and potentially turn this into a high-grade economic silver resource. So yeah, it's pretty exciting there. In parallel, we will also be doing some metrology and metallurgical work to try to understand how we might interpret the economic viability of that mineralization hand in hand with the question of geological continuity.
And finally, with multiple projects advancing, what near-term milestones should investors and stakeholders be paying attention to?
Well, look, with everything that we have going on, I'd say that we will have an extremely high amount of news flow to the extent that most of what we're doing is commercial and price sensitive. I think I've just kind of mapped out something like probably 40 price sensitive or material price sensitive announcements that we would expect this year as we go through all these different programs. So there will be news flow and a lot of major milestones that are the news flow is responsive to. I mean, the first thing that we're doing right now is something like 50,000 meters of drilling between now and the end of June. So there's going to be a lot of information coming out there. And then this will basically culminate in a DFS for our stage one Central Gawler Mill around middle of the year, and then transitioning into front-end engineering design and commercialization. And then the stage two large-scale Tonkilia asset, that would then feed into a pre-feasibility study and a mining lease application, essentially an approval to build that project also at the end of the year. So this is quite a big year for us. It's essentially our pivot point from 5 years past as a theory player, as an early stage developer, then moving now into production and growth and long-term regional consolidation.
Alexander, thank you so much for your time and your insights on Barton Gold.
Thank you.